Welcome back to the Deep Dive. Today we are digging into, I think, one of the most interesting earnings stories we've seen this quarter.
Oh, for sure.
We're talking about American Public Education, ticker APEI.
Right. And their Q3 2025 results were, well, it's like a tale of two different companies in one earnings call.
That's a perfect way to put it. On one hand, you have this incredible, accelerating profitability story.
A massive bottom line beat. I mean, just huge, driven by some really smart strategic moves and booming nursing enrollment.
But then on the other hand, all that good news was kind of overshadowed by this big cloud on the horizon.
A federal funding headwind.
Yeah.
Yeah, a pretty serious one that slammed their military segment right at the start of Q4.
So our mission today is to cut right through that noise. We're going to give you the full picture, the strategic cleanup, how they pulled off this profit surge, and why the market's reaction felt a little muted.
Well, the big theme from the call on November 10th was this pivot. APEI is moving from years of restructuring, selling off parts, fixing the balance sheet,
right,
and they're becoming a really focused, serious cash-generating machine. So let's start with the numbers that blew everyone away.
Okay, let's do it. The knockout quarter. And you were not kidding about the beat. GAAP earnings per share came in at 30 cents.
30 cents. And you have to remember, the consensus, what the street was expecting, was negative 9 cents.
That's a 43-cent beat. A surprise of over 400%.
It's just phenomenal. And a year ago, they were at what, 4 cents?
Just 4 cents.
Yeah.
So that kind of jump doesn't happen by accident.
No, that's pure operational improvement right there.
The top line was solid too. Revenue was about $163 million.
Which was a nice little beat, up about, 6.5%, 7% year over year?
But like you said, the real story here is the profit surge.
Exactly. Adjusted EBITDA. And that's really the key number for operational profit. It jumped 60% year over year to almost $21 million.
And the margin expansion, that was the key.
Yes. The adjusted EBITDA margin grew by about 424 basis points.
Okay, so for anyone who doesn't live and breathe this stuff, what does that mean in plain English?
It means for every dollar of revenue they bring in, they're turning over 4 cents more of it into pure profit than they did last year.
A huge leap in efficiency.
It's the proof. I mean, this is the quarter that proved their strategy of cleaning house is translating directly into high-quality cash flow. The momentum is just undeniable.
So we know how much they grew. Let's talk about where it came from, because the real story here is all about healthcare.
That's the signal through all the noise. The growth was completely led by their nursing schools. Hondros College of Nursing, or HCN.
Yeah.
Revenue up 19%. Enrollment jumped almost 18%.
And Rasmussen University, RU, the other big piece.
Same story. Revenue up 16%. Enrollment up over 10% to nearly 15,000 students.
And they have this strategy for doing this, right? This filling the back row thing.
I love that name. Yeah, it's just a really smart capital light way to grow. They're not building expensive new buildings. They're just maximizing the space they already have, getting more students into existing classrooms.
Yeah.
And it's working on ground enrollments were accelerating, up 13% going into Q4.
So that's the growth engine. But what about the legacy business, APUS?
American Public University System.
Mm-hmm.
Even with all the drama we're about to get into, they still grew net course registrations by over 8%.
Which brings us to the cleanup. Because without understanding that, the overall growth numbers actually look kind of modest.
That's such a critical point. They finally completed the sale of Graduate School USA, GSUSA, back in July. And that thing was a huge drag.
A drag is putting it lightly. GSUSA revenue declined 90% in the quarter.
Exactly. So that was masking the fantastic performance of the core businesses.
So if you take GSUSA out of the equation entirely, what would the growth have looked like?
Consolidated revenue growth would have been around 12% year over year. A totally different story.
And they got rid of it cleanly, too.
Very cleanly. The loss on the sale was only about $3.9 million, which was way lower than the $6 to $8 million they had originally estimated.
And all of that cleanup leads directly to what I think is the biggest win of the quarter, the balance sheet.
Oh, the balance sheet transformation is incredible. Operating cash flow is up 56%.
And they ended the quarter with $193 million in cash.
And crucially, a net cash position of almost $97 million. That means more cash than debt.
So they're effectively debt-free.
After years of being leveraged.
Yeah.
Yeah, it's a total game changer. It just de-risks the entire story.
And this isn't just a one-time thing. They've engineered, $10 million in permanent annual cash flow improvement?
Exactly. It's not some accounting trick. They redeemed some preferred equity, which saves $6 million a year in dividends.
Right.
And selling GSUSA got rid of a $28 million lease liability, saving another $4 million a year.
So that's $10 million pre-tax. That hits the bottom line every single year from now on.
Permanent financial flexibility.
Yeah.
It completely changes their cost structure, and they've pulled way back on capital expenditures. It's a clear pivot from investing to just harvesting cash.
Okay, so they've got all this cash now and they've simplified the business. Where is management's head at? Where's the focus going?
It's all about healthcare. They said it again and again on the call. Nursing is a structurally high-demand field, and that is their growth engine.
And they're focused on those first licensure nurses, right? LPNs, ADNs, BSNs.
Yes, and the ROI for the students is a huge selling point. They talk about LPNs making $66,000 a year, ADNs making $88,000.
These are real life-changing careers. And importantly, jobs that aren't really at risk from AI disruption.
That's a huge point. We also saw a big leadership change. A new CFO, Edward Cudaspati, came on in October.
And what's the signal there?
Margin discipline, capital allocation. They are doubling down on profitability, not just, growth for growth's sake.
Okay, but there was one little speed bump. This planned combination of their schools, it got delayed.
Yeah, a minor procedural thing. The Department of Education basically said they needed to use a different process.
Is that a big deal?
It's not a showstopper.
Yeah.
But it does push the timeline back to Q3 of 2026.
So the financial benefits, the synergies, we won't really see those hit the numbers for a while.
Right. Which brings us to the big elephant in the room that really overshadowed the whole quarter.
The Q4 headwind?
The Q4 headwind at APUS, their military segment. And this was totally macro-driven.
The federal government shutdown, it turned off the spigot for tuition assistance for the military.
It did. Net course registrations in October just cratered. They saw about 1,700 registrations.
Which is what, 10% of a normal month?
About that, yeah. So management had to react instantly. They cut costs, pulled back on marketing spend to the military, just went into triage mode.
I remember this happening back in 2013, and it took a while for that funding to normalize. Is the market right to be nervous that this could last?
The nervousness makes sense, but we're already seeing a partial rebound. A big funding bill passed that restored some of that tuition assistance.
So what did that do?
It brought November's registrations back up to about 30% of the prior year's level.
Right.
So not great, but it's a start.
And there was a really interesting little detail in the call. Some military students just paid out of pocket.
Yes.
Yeah.
Which, first of all, shows you how sticky those customers are, but it also has this positive side effect on a key metric.
The 90-10 rule.
The 90-10 rule, the law that says for-profit schools can't get more than 90% of their revenue from federal aid.
So every student paying with their own cash helps them on that compliance metric.
Exactly. It's a key de-risking factor.
So all of this pressure is what led to the, let's say, cautious Q4 guidance.
Right. They're guiding for a 6 to 9% year-over-year decline in revenue for Q4. Basically signaling, look, this quarter's going to be rough because of this temporary disruption.
But, and this is the key point, despite that Q4 dip, they raised their full-year guidance for profit.
Raised it significantly, up 70 to 95% on net income for the full year. It just proves that the underlying profitability of the new, streamlined company is incredibly strong. The structural fixes are working.
Okay, so let's put it all together. You have a massive EPS beat, raised full-year profit guidance, the balance sheet is pristine, huge cash buffer. But the stock only popped mid-single digits. What gives?
That is the core disconnect right now. The market is laser-focused on the temporary military headwind.
And they're completely discounting the permanent structural improvement in the nursing business.
Exactly. Investors want to see proof. They want to see that APUS rebound in Q1 2026, and they want to see that the nursing growth is sustainable.
Which makes the upcoming catalysts super clear.
Crystal clear. First, we need to watch for that APUS normalization in Q1. And second, and maybe more important, is the Investor Day on November 20th.
What are you looking for there?
A multi-year plan. I want to see aggressive but credible margin targets. I want to hear about capital deployment. If they do that, they could force the market to completely re-rate the stock.
And the analyst reactions were all over the place.
A perfect reflection of this disconnect. You had B. Riley and D.A. Davidson raising their price targets, focusing on a long-term story.
But then Zacks kept a sell rating.
Citing that short-term volatility. It's a classic battle. The stock is trading on its past, which is military volatility, instead of its future, which is healthcare compounding.
All right, that brings us to our favorite segment. This is not financial advice, where we pitch a, let's say, outrageous but plausible trade idea.
And let me just say the mandatory disclaimer. This is for educational and entertainment purposes only. We are not your financial advisors. Please talk to a professional.
Okay, disclaimer done. Here's the pitch. The market's reaction tells you it is completely fixated on the temporary military problem and is ignoring the permanent high-margin growth in nursing.
Basically, the stock is being mispriced. It's being valued like a volatile military contractor.
When it's actually turning into a premium healthcare education company, and those get much, much higher multiples.
Sure.
So the trade idea is a pair trade. You go long APEI.
You're betting they can navigate this Q4 storm, which they've done before, back in 2013, and that their 2026 results will force that re-rating we talked about.
And here's the outrageous part of the pair trade. You short a different for-profit education company.
One that's lower margin, less diversified, and doesn't have a strong healthcare segment to fall back on.
Right. You use those proceeds to fund the long APEI position. You're basically betting on APEI's structural strength against a competitor's weakness.
And you do it all knowing that APEI's $193 million cash pile is this incredible safety net against any short-term macro shocks.
The thesis is pretty simple. The balance sheet is fixed, the growth engine is nursing, and the military headwind is temporary. The profitability is structural.
So to wrap it up, APEI delivered a powerful quarter. Profitability and cash generation are booming thanks to that restructuring.
They've successfully positioned nursing as the future, even with all this macro noise.
And they are officially in cash harvesting mode, which gives them a huge buffer.
So the final thought for you to chew on is this. If management nails the investor day, if they lay out a clear path to long-term margin expansion and they execute on the APUS rebound,
does APEI become the next big compounder in the education space?
And does that make today's valuation look incredibly cheap in hindsight?
That's the question.
That's the question to ponder. Thanks for tuning into this deep dive, and we'll catch you on the next one.